Okay, well, good afternoon, everyone. We are going to go ahead and get started. And I'll just continue to let people in as they join the Zoom meeting today. But for those of you who don't know me, but I think everybody does, my name is Christina Love, and I'm the chair of the Economic Development Committee. And on behalf of the Leavenworth Alumnae chapter and the Economic Development Committee, I want to welcome you today to our financial workshop. And so before I introduce our amazing guest speaker, I do want to first thank Sarah Michelle Dutton. She is a member of the Eastern region and a member of our National Economic Development Committee. And so she has worked hard to ensure we had an amazing speaker today. So I definitely owe her a phenomenal thank you for helping coordinate today's workshop. She's normally here, but as being part of the Eastern region, they had their Eastern region cluster today. So she couldn't be with us. And there's normally information that she does provide before each of these presentations, and I will provide that on her behalf. So I want to just take a minute to talk to you a little bit about dfree and the partnership that Delta Sigma Theta Sorority Incorporated has with dfree. So we've been a partner for over 10 years now. And one of the primary goals of dfree is to really help people become financially free. That's one of the goals of the many that are out there. And that's with our guest speakers here to talk a little bit about as far as our topic that we have today. But Delta Sigma Theta, we are the first Greek lettered organization to launch dfree. And we've been in this partnership for over 10 years. And we currently have 200 chapters that are in partnerships with dfree. And of course, we want more chapters to become part of this amazing program. And to date, with the communities that we have served, we have reduced more than $9 million in debt. And although an amazing accomplishment, again, we do need more chapters to participate. In the past, our chapter Leavenworth Alumni, we have participated in the $1 billion challenge, but there's still so much more work that we need to do. And I know that we will continue to do that work, because with anything that we do personally and professionally, anything that we can do to help people achieve financial success is obviously a win-win. So with that, it is my pleasure to introduce to you today our guest speaker, Tamika Stembridge, Esquire. Tamika is a former entertainment attorney, a strategic consultant and manager by trade that works daily to turn dreams into reality. As an MBA-loving attorney, a lifelong lover of music, and business professional with experience that spans corporate, nonprofit, and startup organizations across a variety of industries, including entertainment, education, and fashion, Tamika brings a wealth of skills, talents, and passion to any endeavor. With a mind for all things creative, commercial, and community, she now lends her talents beyond traditional entertainment and serves as the executive director of the dfree Global Foundation. Her blend of leadership, vision, insight, follow through, passion, personal commitment, and unique ability to engage people at all levels is a prized catalyst for growth and service that dfree requires to meet the needs of the community at large. She holds a bachelor's degree in economics from Spelman College and both a Juris Doctorate MBA from Rutgers, the State University of New Jersey. She resides in Philadelphia, Pennsylvania, and enjoys spending time with her family. And she is committed to pursuing a full and free life. And one of her famous quotes is, "My job is to manage influence and impact and create a world of difference." So with that, let's give a warm virtual welcome to our guest speaker, Tamika Stembridge, Esquire. Welcome.
Hello, 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 ladies and gentlemen. I think I saw a gentleman enter the room. I am very, very pleased and honored and humbled to be with you all today. I was letting Christina know this is actually my third time presenting this today. And while for many people, they'll be like, oh my God, it's almost over. I'm really excited because with each group, my goal is really to make this conversation meet you where you are. I've been doing dfree. I've been working with dfree for the last 8 years of my life. And hopefully, I believe we have an hour scheduled today. We'll be able to kind of walk through not just the presentation, but really take the information and make it palatable to where you are. And so I like to start here. dfree is a national nonprofit that was birthed out of a vision of senior pastor DeForest B. Soaries Jr. from New Jersey. But I like to start here. The premise and the promise of dfree really rests on this. We are a faith-based program. And so Proverbs 13:22a says that a good person leaves an inheritance for their children's children. And so wherever we are financially right now or going into the future, this for the most part should be the goal, not just to serve ourselves, not just to live, a full and free life on our own, but to be able to leave something for the people that we love and the organizations that we care about when this is all said and done. And so with that, like I said, Dr. Sori started dfree in 2005 as a ministry within his church with the goal of serving 1,000 families and helping them to get out of debt. So that was his mini goal. Since then, in 2005, we've served over 100,000 individuals. We've worked with over 5,000 churches. As Christina said, we work with over 200 Delta chapters. We have Zeta Phi Beta Sorority Incorporated has signed on to dfree over the last 2 years. And we have tons of people around the globe that are actively participating in our programming. And the one thing I want to point out, while we do focus on financial freedom, our mission is really to be a transformational lifestyle movement that, yes, promotes financial freedom using biblically based principles and practical approaches to financial management. But the focus really is on lifestyle. Your money is doing what your life is doing. And so I like to start there. People say, oh, I have money problems. I don't know how to manage money. The reality is we're not managing our lives properly if our money is doing the funny dance. And so we really like to help people focus on the spiritual, mental, emotional, psychological aspects and behavioral and habitual aspects of managing your life and how those things are impacting your finances. And we do that through 3 ways: education. So at its core, dfree is a 12-step curriculum that walks you through the process of acknowledging where you are and getting you to a point where you can actually give back. Motivation. So Christina mentioned the $1 Billion Challenge. That is our shared platform where we encourage and incentivize people as they pay down debt or set up savings goals to achieve. And lastly, support. So we partner with companies and financial services providers to get you access to vetted resources to help you along your financial journey. And so, like I said, I mentioned the 12-step process. So that's here in the middle. The 12 steps are broken down into 4 levels: get started, get control, get ahead, and give back. And so that's the core programming of what dfree offers. But in addition to that, we also offer a series of seminars and workshops around a variety of financial topics. This presentation is one of those. And so I want to draw your attention really quickly to something we like to call the dfree lifestyle continuum. And so, like I said, this presentation really, in all of our presentations, we like to meet people where they are, and where they are tends for us to look along this continuum. So first and foremost, our basic dfree training really focuses on helping people to pay down debt and get rid of credit cards. And you'll hear later on, we're not anti-credit and debt, but if you're relying on credit cards as an extension of your income or as a part of how you manage your lifestyle, then we really want to move you from lifestyle reliance on debt and credit to strategic reliance on debt and credit. And so that's at the basics of what dfree does. Next, we help you to build an emergency fund. That emergency fund keeps you from having to return to the use of credit and debt when life happens, because we know that life happens, things happen. And then we talk about building wealth. So your investments, your real estate, stocks and bonds, having a diversified portfolio, meeting with a financial advisor, and doing all those things to really start to accelerate the growth of your financial portfolio. And then I would be remiss if we didn't talk about wealth protection. That is risk management, life insurance, long-term care, and disability insurance. And those things are in place to keep you from drawing down on the wealth that you're building when a major life event happens. So if you become incapacitated, if you have a bout with breast cancer, you're not dying, but you will have an extended time away from work or not be able to earn additional income. And so you want to have things in place so that if a major life event happens, you don't run the risk of losing everything you've worked so hard to gain. And then last but not least, prayerfully, at the end of life, you will have a legacy to leave behind. And we help to teach people about estate planning, including trusts, wills, power of attorney, and things of that nature. So again, I'll ask, and we'll do it in a second, we'll do an assessment to figure out where you are on this financial continuum. I also like to point out there's an order to things, and most things in life. And a lot of times we may be, you might have a will, but you're still in debt and you're building wealth, and you might have a little bit of life insurance. And so your financial dance, while it may look like you're touching on each of the circles, there may be something that's out of sync that if you just addressed it, it would help to make this continuum feel a little bit more smooth. And so our goal is really to help you put these things in order and think about them in order so that you don't get overwhelmed or you don't get sidetracked by, everybody's talking about investing in Bitcoin and you're like, I just want to pay my car note off. It's okay to focus on that. And it's okay to not participate right away so that you can really focus on what your individual financial continuum looks like. Does that make sense? All right. I mentioned in the chat, I really like for my presentations to be interactive. And so this is my first point of interaction. What would you do with $500 right now? You could drop it in the chat. There's only a few of us on, so if you want to unmute your mic, you can share it. But what would you do with $500 right now if someone gave it to you? Anybody want to share? Okay, so buy Bitcoin. Okay. Anyone else? $500. It's free, no strings attached, no rules. Okay, Bitcoin it is. The rest of you, I'm not going to make any assumptions around what you would do. Help out family. Okay, that's a good one. Anyone else want to share? Savings, buy groceries. Excellent. And the reason I like to start us off with this question, because a lot of times this one question becomes an indicator of at least where our minds are around our money and where our intentions are around, around money. And I like to start off with this quote also, that understanding your money story and your money mindset is a great starting point. So for people that don't like having the financial conversation, they don't, like getting involved in this thing, they don't want to talk about it, they may be running from a financial issue, thinking about how you ended up where you are, good, bad, or indifferent, really helps you to understand the tone of how you're going to move forward related to your finances. So for example, for me, my grandmother and my mom both worked, had great jobs at Johnson & Johnson. My mom took care of her 3 girls and she, got us what we needed, a little bit of what we wanted, but she was on a mission. I got 3 girls, I got to get them through college. That's what I'm going to focus on. My grandmother was the supplemental parent. And so she worked all week and on Saturdays we went shopping. And while she told me to save money, she showed me going shopping on Saturdays. And so when I got grown, you could imagine what my money story was. I worked hard all week. I paid my bills like my mom showed me, and I went shopping on Saturday. That savings part, I kind of missed it a little bit. Outside of my 401k, I lived with the salary I had. I was excited. I was making a lot of money. I'm young. I'm single. I'm hanging out. And, as I got older and life started to shift and things started to happen and I wanted to make other decisions in my life, I really had to come and have a reckoning with my money story about how I got to where I am. And a lot of times the dfree process starts with getting started. And the first step is admitting the problem. And the problem may not necessarily be a problem per se, but it really is getting to the root of why you are where you are financially. And then your money mindset is really about how you feel about money. Do you feel like it's a limited resource? Do you feel like it's abundant? Do you feel like there is financial, availability to you? Do you have an attitude when you pay bills? Are you mad when something happens in your life? All of those things really contribute to how we respond from a financial standpoint. And so much of how we move and how we show up financially is really wrapped up in our life and kind of how we manage life and how we manage our emotions and things of that nature. So really quickly, I want to have you kind of do this assessment for yourself. You don't have to share with anyone, but ask yourself kind of where you are on the continuum. And feel free to drop in the chat if you'd like. I love interaction. As you can tell, don't leave me here talking to myself on a Saturday afternoon. Are your dfree basics covered? And the basics for us are really having a budget/spending plan, which we're going to talk about today, and having a debt pay down plan if you are in debt or you have some debts that you want to pay off. That's the first step. Do you have an emergency fund? And an emergency fund for us at the minimum is, do you have $500 in liquid capital available to you within the next 24 hours? That's a bare minimum. Now, most people's emergency fund, they tell you you need to have 3 to 6 months worth of living expenses saved. I agree with that. However, you don't go from having no savings to 3 to 6 months worth of living expenses saved in a 24-hour period. Everything happens progressively. And so if you can start with just $500, that means you can cover a blown out tire. That means you could pay a deposit on a new water heater if you needed to in cash without using a credit card. You get the 500, then you move to 1,000. Now you can cover a more substantial life event should something happen. And so it really is about moving things along progressively. Then you have to ask, are you building wealth? Do you have a retirement plan in place? Are you doing active savings and investing in the stock market or bonds? Are you investing in real estate? Do you have other resources or money or things that you're putting away for the long term? I love that Tanya said yes to all. Okay, excellent. And then last but not least, is your wealth protected? Meaning, do you have the right insurances in place such that if something happens to you while you're living, that you're able to take care of that and it won't impact what you've grown in your nest egg? So again, I like to share this because it gives you an idea of kind of the things that you might need to work on. If everything's in place, then great. And if it's not, it just gives you an idea of what things you need to pursue and kind of how you need to prioritize it. Again, if you're just trying to figure out how to manage your money for the month, I'm not going to expect you to focus on building wealth or protecting your wealth because you're just trying to figure out how you manage your money from month to month. And so it's okay to be where you are. It's just an indication of what you need to work on. Having a financial advisor could be under building wealth and wealth protection. So for example, I have an insurance advisor, that person would be under wealth protection. I have a retirement planner or a certified financial planner, that's more on the building wealth side. But 9 times out of 10, your financial team, they're going to work together because you don't want your long-term goals to be overshadowed by something that you need to have happen in the next 3 to 5 years. You don't want your life insurance to be, so exorbitant it keeps you from paying down your bills month to month. And so again, these things are all gonna fall in line together. But I do advise that everyone have at least someone in your financial corner that's an expert at finances that can give you some real solid, independent, uninfluenced, unbiased guidance on where you want to go financially. Not just where the world is going, but what your goals are. You might want to retire on a beach in Tahiti and never have to work a day in your life after the age of 65. Someone else in retirement might want to be a traveling grandparent. And so they may have different requirements in terms of where they live, their lifestyle. All of those things are really going to play a part in how you design your financial life. Okay. So while the rules may be the same, or at least the tenets of what you're trying to build may be the same, how you go about building wealth may be different. How you go about protecting your wealth may be different. And so that is why it's important for us to be thinking about this individually and not just kind of the run of the mill of what everyone is doing. Okay. So today's presentation really is about just ensuring where you are today is setting you up for where you want to go tomorrow. And so the ground floor of managing your finances is, for us, your budget or your spending plan. And this is normally an eye opener for people. When you think about your budget, most people list their income and expenses. At a most basic level, that is what a budget is. However, from a dfree perspective, we recommend taking a little bit more of a detailed approach to your budget. And in fact, we call it a spending plan. So I'll ask you here, if you have a budget and you stick to it, great. Most people have a budget and they kind of stick to it. They kind of put it in a notebook. But if something happens, they decide that they're just going to go off the plan and do whatever they want to do. And budgets tend to feel restricted. If you work 40 hours a week or however many hours a week and you get paid, you want to do whatever you want to do with your money. A budget can kind of get in the way of that if you have that mindset. And so the spending plan, we feel like, is a little bit more permissive, but also more inclusive. And so I want to walk you through kind of how we approach that. On the income side, you want to consider all of your sources of monthly cash flow that are consistent and anticipated on a regular basis. So for example, your employment, so that's your regular salary or hourly pay, entrepreneurship, so if you pay yourself out of your business, what that looks like consistently. If you have a side hustle, my mom braided hair on the weekends, wasn't a formal business, but she set a goal that I'm going to make an extra $200 a week braiding little girl's hair on the weekend. And so she was able to include that as a part of her budget because she knew she would do it every week. And then other income, alimony, child support, other special payments. Anything that's consistent and is going to show up every month, that should be included as a part of the income side of your budget. On the flip side, you should have savings, giving and tithing, or expenses. Those are kind of the general expense categories. But if you dig a little bit further into how we look at expenses, you want to almost categorize things as savings. So that might include your auto savings, like you save $50 every paycheck, and then you're investing. So you might have, $100 a month that you invest in the stock market. So that is kind of broken out. You're giving and tithing, whatever you're giving to church or whatever or other organization you support regularly, that's included there. This is the biggest distinction here. Your bills should have their own section in your budget. Those are the things you are required to pay every month in order to live, in order to survive. Water, electricity, gas and electric, whatever those things are, like you have to pay those things in order to have a functioning household. Your debts is the next category. That is the things that you tend to, they tend to carry an interest rate, and they ultimately should be paid off. Now, this distinction is interesting because most people just list their expenses. They know what they're paying every month, and it's like, okay, I give this person 50, this person 100, and it's all collapsed together. And so you know what comes in and what goes out on a monthly basis. But if you're not making the distinction between bills and debts, it's almost as if you're not setting an intentional goal around paying those debts off. And that is where the debt area is kind of the biggest area of opportunity for people to start seeing the possibility of financial freedom, because again, they're supposed to disappear. You're not supposed to have a car note for the duration of your life. You're not supposed to have, a credit card balance from now until eternity. Eventually, the credit card balances should hit zero. Eventually, the car note should go away and the debt should be reduced. Even student loans, eventually they should be paid off, or if by the grace of God and Joe Biden, they will go away. And so separating these two categories and making this distinction in your budget really gives you the opportunity to see what is possible if you don't have debt. Okay. And then the last category, if you don't have debt, amazing, so be it, bless you. But the other category, even for people without debt, is lifestyle expenses. What you don't include in your spending plan tend to be the things that derail your financial plan. So for example, the hair salon, the nail salon, lunch out every day. Everybody uses the Starbucks example. If you are going to happy hour, if you're a brunch queen, those things that you like to do in your life to make you feel like a human being, if they're not included in your spending plan, those are likely to be the things that will derail your overall financial plan. Because whoops, I overspent. I'm at too many brunches this month and I got 6 days before I get paid again. You're now suddenly relying on a credit card because you went too hard at brunch. Okay. And it's really important that you create, I don't want to be restrictive in the sense to say, no, give up Starbucks. What I want you to see in this is that if your lifestyle expenses and your debts and your bills and all of those things are beyond what your income can handle, you might need to be over here in the entrepreneurship side hustle realm and look at ways to bolster your income so that they support your lifestyle, if you're not in position or in willingness to sacrifice some of the things that you enjoy. So again, not meant to say give it up, but really understanding what your money is doing based on what your life is doing month to month. If you like brunch every Sunday, beautiful. Just make sure you have at least $50 a week or $100, depending on how hard you go at brunch, included in your monthly budget. Because if it's not there, then there's no parameters within which that you're willing to spend. And you're just swiping and swiping and swiping. What I did not get to share with the groups that I worked with earlier is this whole concept also of relying on easy methods of payment. So now you can literally tap your iPhone, your iWatch, and pay for something. You can tap your debit card. You can shake your phone and pay for something. And the reason these technologies exist is to desensitize us from the value of money. I used to live next door to Target. Like literally my apartment complex was next door to Target. I could go to Target for toilet paper and leave with the television. And if I was paying with my debit card, I would not feel the difference in price because a swipe is a swipe is a swipe. If you are in a position where you feel like you're overspending or you want to get a handle on where your money is going, you don't know where your lifestyle budget should be, I want you to take this challenge for a week. I want you to go to the bank. I know it's a little late in the day today, but go to the bank, preferably inside the branch. Withdraw as much cash as you think you need to survive for the week. Request it in large denominations, the largest denomination they have available. And then monitor your spending. Leave your debit card and credit card and everything at home for the week and only rely on that cash. If you track what you are spending with this cash, you will suddenly start to see where your lifestyle expenses are. Uh-oh, I have a child. Hold on one second. I'm so sorry. I thought I I'm so sorry. I thought I had my office door locked and my toddler just came in. But again, if you rely on cash for that week and move yourself through your normal day-to-day life, you will start to make different decisions about how you spend money. So for example, let's say you take out $200 for the week, you have $200 bills. Monday morning comes around, you're getting ready to pass your Starbucks that you normally stop at, but all you have is these $200 bills. Are you going to stop to break one of those $100 bills for a $5 cup of coffee? 9 times out of 10, you're not, because you don't want to break a big bill for a small purchase. So now add Starbucks to your lifestyle list. Again, going into Target, if you're going for toilet paper, you have $200 bills with you. You walk in, you're tempted by the Starbucks counter, and then you see the women's clothing and the jewelry, and you make your little circle, and you're packing up your cart, but then you realize, I have these $200 bills. I got to put this TV back, one, because I didn't take out enough money for the television, but also I really only came here for toilet paper. One, you might not even buy the toilet paper because you don't want to break the $100 bill, but you will shrink your cart down to the necessities because again, you have a finite amount of money to spend and you're trying to be conscious of how quickly it's going. And so that's a challenge that I try to give to all of our dfree classes, wherever you are. Because again, even if you have a sound financial, like if your financial house is in order, your day-to-day spending and your regular spending habits are what's going to define how you go forward. And I'll also put this caveat in. A lot of people that are in financial challenges may not have entered there because they overspent. It could be divorce. It could be a bout with illness. It could be, being downsized from your job. Life happens. And those situations could put you in a precarious financial situation. But even if those things are what's in your way, how you respond to life from that moment forward determines whether or not you're going to get out of that situation. And so again, it really is about understanding where you are and really managing your mind, your heart, and your habits around your money on a day-to-day basis, and really trying to keep the lifestyle expense piece controlled and really focusing in on the debt aspect of your spending plan if you have it. Okay. As we transition, I'll also share, I shared some handouts with Christina. We have a dfree monthly budget template. You'll notice in the template, consumer debt is listed twice. I believe my graphic designer made a mistake. However, I would like to say she was just reinforcing the point around debt being the biggest opportunity in your spending plan to get ahead financially. Think about it. What would you do if you didn't have to pay a car note? What would you do if you didn't have to pay credit card bills? What would you do if you didn't have to pay student loans? That is your opportunity. Without changing your income at all, attacking the debt portion of your spending plan really helps you to get ahead financially. And even if you can't move the needle on it right away, you now have a target. I want to be debt free. I want to get rid of this part of my budget by XYZ date. And you can start to make those adjustments. All right. And so the rest of the presentation is really going to focus on how we go about managing that debt section of our spending plan. And so I want to pause here to talk a little bit about credit. If you're anything like me, nobody taught me about credit. I just knew that, that expensive t-shirt that I got when I was on campus was the start of my career with credit. And I've had to figure out how to manage it over the years. And so again, over time you learn, but I always like to make the point, think of credit as a reference. It is your financial reference, to the financial services industry. It is how they think of you. And how you manage it is an indicator of how you manage your life. Are you responsible? Can I trust you if I give you $150,000 to buy a home, that you will take care of that asset, that you will pay your mortgage on time, that you will not take my money and throw it down the drain? Do you honor your obligations? Meaning I gave you this $1,000 loan. It's supposed to be paid off, in 2 years. Have you paid it off? Can I trust you? Are you going to take my money and run? Okay. That is what your credit score really is. And your credit profile, which is what undergirds your credit score, it impacts more than credit cards. So a lot of people say, oh, I need to manage my credit, my credit score so that I can get the best interest rates and things like that. Yes, that is true. But you also have to think about, again, credit is a reference. Employers look at your credit profile and sometimes your credit score. Insurance companies, from car insurance all the way up to life insurance, they consider your credit profile when figuring out how much money they need to charge you every month. Rental companies, if you're trying to get an apartment or again, trying to get a mortgage, they want to know, do you pay your bills on time? Can I trust you with my stuff? That is what credit is. And to the right, you see the general scoring model is the FICO scoring model for credit scores. This kind of gives you a good indication of how people will view you based on your credit score. Now, I have to say this, I would not be dfree if I didn't. Your credit score is not an indicator of your overall worth in life. Take it personally, but not that personally. Use it as a metric like you did your GPA in school, okay? I don't want anyone to feel shame about where they are on this list. I don't want you to feel like you're less valuable as a person if your credit score isn't exceptional. I don't want you to feel like you should be ashamed to put your head in the sand if you don't have a very good credit score. This is an indication of where you are at a point in time. And if you're serious about managing your financial well-being, an opportunity for you to set a goal and move towards it. That's it. You are not your bank balance. You are not your credit score. You are still valuable. You are still a child of God, wherever you are financially. And I have to say that because there is so much shame built up in how people manage their finances or don't manage it. How much you earn, what you drive, what you wear, all of those things are external to you and are not an indication of your overall value. Okay. So a little bit of fine print. There are other scoring models out there, but FICO tends to be the most used and is also the basis of those other scoring models. And so if you understand FICO, you kind of have a general understanding of how the other credit scoring models work. Lastly, I'll share that depending on the kind of credit that you're applying for, different scoring models or considerations may be used. For example, if you're buying a car, most auto lenders are primarily looking at your history with auto lending. So did you pay your former car note on time? And if you don't have a former car note, then they'll look at your other the other credit that you may have available to you. Whereas if you're applying for a mortgage, they want to know from top to bottom what your credit story looks like. Even the things that don't show up on your credit score, they want to know everything about you. Again, so it all depends on what you're applying for, how deep they're going to go into your credit profile. And with that, because lenders get to decide what they're looking at when they want to extend you credit, your biggest point of power in managing your credit score is really in managing your credit report, your credit profile. Because if that report is accurate and if it reflects positive credit behavior, then you should be comfortable and confident in the range of credit score that you could potentially see anytime you're applying for credit. Okay. You get access to your annual credit report from each of the 3 reporting agencies, Equifax, Experian, and TransUnion, for free once a year at annualcreditreport.com. So this is your opportunity to pull your full reports to see everything that anyone in the financial services industry sees about you. You don't have to pull all 3 at the same time. You can do one at the beginning of the year, one at the middle of the year, one at the end, but you will get a full credit report for free from each of these agencies at least once a year by visiting this website. You should not have to pay for anything. And then most of your credit scores are able to be monitored regularly. So most banks and most credit cards now will offer you some kind of indication of what your credit score is or some kind of credit score monitoring every month. Okay. And with that, what's happening is it gives you an opportunity to monitor what your score is doing. So let's say you are a 650 and then you hit, for some reason you open it up one day and it's a 580 and you didn't do it. They do that so that you can monitor yourself for fraud protection. So that means somebody's done something with your social security number and you need to go look into it. And the reason that's important is because your credit score and your credit report is your responsibility. Even in the instance of fraud, it is up to you to manage and fight and research the fraud, or at least report that fraudulent activity may have happened. And a lot of people, if you see an instance happen like that, or you can't figure out why your credit score went down or what's happening on your credit report, we tend to stick our head in the sand and not really look at it. And we think that it'll just figure itself out and, oh my God, somebody's out there doing something. It is your job and your responsibility to dig into the fraud yourself. You have to report it. A lot of times you have to go in and not just report it to where the fraud happened, but you have to report it to the credit bureaus. It is your job to advocate for the cleanliness of your credit report. And this is also where, for example, you might have had a name change. Maybe you got married, maybe you got divorced. Maybe some things use your middle initial, some things don't. Maybe you have a cousin that has the same name as you. Even if your credit score isn't the same, these are computers, these are people, they mess up. Things get mixed up. And so you want to make sure that you are actively reviewing your credit report regularly so that you can make some changes if you need to. All of the all of the credit reporting agencies, most of them do allow for digital reporting of disputes. You just have to go through their website, or they may generate letters, like kind of templates that you can use to dispute things on your credit report. But again, you have to do the work to make sure that your credit report is clean and accurately reflects your credit behaviors. Okay. I see a question in the chat. What's the difference between FICO and the other credit scores? Again, they all are reflective of your credit report. Some of the other reporting scores, they might go up to like a 900 or 1,000 every so often. Like now, because as a community, I hate to say it this way, we're so much more focused on our finances and we know a little bit more about the credit game, that people are now having higher credit scores. And so they just move the needle a little bit. And so you might have had a 750 last month, but according to this new scoring model, now you're at a 720. It's unfortunate, but it's, the financial industry is designed to make money. And if everyone has amazing credit and if everybody's paying their bills on time, they're not making money on interest. They're not making money on extending credit. So, some people are opting out. They've built themselves up to a point where they can borrow from themselves, whether it's a life insurance policy or whatever they're borrowing from. They're not using traditional financial institutions. And so these institutions need to make money. And so every now and then, a new scoring model pops up, a new way to look at things pops up, and we just have to roll with it. But again, the thing that undergirds all of these scoring models is your credit report. Okay, so as long as your credit report is active, even if your score fluctuates somewhat, a strong credit report is going to generate a strong credit score, regardless of what model is being used. Okay.
Hi, Tamika. I did receive 2 questions in a private chat.
Okay.
All right. So the first one is it true that you can have too many credit cards? Is that a bad thing? So they have a few, but all are paid off because they've had them for so long. How does that impact, I guess, someone's credit report, or even if it's just having too many, a bad thing?
Right. So that's a great question. My next slide talks about what really makes up your credit score. The bulk of your score is actually your payment history. The second highest is the amount that you owe. You will see that your credit history only accounts for about 15% of your credit score. So if they're older accounts, and it sounds like this person has paid them off, they've been super responsible. If they're old accounts, even though they're still sitting on your credit report, if they're not active and you're not actively using something on them, your score is kind of flat, or it may even decline a little bit because, again, it seems like it's inactive credit, even if the accounts are still open. And so the goal is, it's like juggling. I used this analogy a couple of days ago. When you're dealing with credit, you want to have some credit accounts available. You want to keep the balances low, but still use them enough so that it looks like you're active. So that's why they say, okay, use your credit card. Well, we'll get to this. Let me back up real quick. With credit accounts, also, we recommend major credit cards only, because some people's wallets are filled with, I got a bank, I got a card from XYZ bank that only exists in East Jablip and they've only been around for 2 years. And you want major credit cards only, Visa, MasterCard, Discover, or American Express, if you are responsible enough and disciplined enough to have an American Express from well-known providers. So if you've never heard of the bank, don't open the card. Okay, because banks are opening. Again, like I said, people are doing this to make money. You have private, rich people that create banks, that create credit cards, that create financial solutions to make money. They tend to carry higher interest rates. They tend to carry big fees. And so you want to go with what you know when it comes to credit. And again, try to minimize your reliance on store credit cards. I know the discounts can be, appealing sometimes, but you don't just want to be opening store credit cards just for discounts, because sometimes the hit to your credit when they're doing the inquiry to give you the card may do more damage than the card itself. Okay. And then you want to check all of the terms and conditions. So that's your APR, which is your annual percentage rate. Any fees. A lot of credit cards now are charging an annual fee or even a monthly fee sometimes. And what that does is, just like the young lady that asked the question, for people that have inactive accounts or they don't use them, like I pay my credit card off every month, they'll attach a $10 fee to your card. And if you're a person that's paid off the card, you may not be paying, they're counting on you not paying attention to your bill because you've paid off your card. And now you have a $10 balance that every month is carrying, and it's adding up and it's adding interest. And if you think you've paid off that card, when they charge you a fee, that fee is included in the balance that you owe, and they can start charging you interest on that. And so again, the industry plays on your inability to meet your debt requirements and also your inattention to what's happening with your bills. Same thing with special financing. People ask, well, should I move my credit card balance to this new card that they just sent me that's offering 0% interest on balance transfers for 6 months or 12 months? Maybe that'll help me pay it off faster. Here's the thing. A lot of cards that offer that kind of special financing deal will charge you a fee, which is a percentage of what you owe. So let's say you want to transfer $500 from a card that's charging you 19% interest to this 0% credit card. Well, if you've had that $500 balance and it's already accrued some interest, and you may owe like $575 on that card, when you transfer it to the zero credit, the zero balance card, in addition to the $575 that you owe, because it's not like they're going to leave the interest with the other company, that $575 transfers to the other card, and that card is going to charge you 2 to 3% when you transfer it. So now you're technically paying more than it would have cost you to just leave the balance on the other card and pay it off. I hope I didn't lose anybody there. So a card that offers you 0% special financing, meaning they're not going to technically charge you additional interest, if they charge a fee for the amount that you balance transfer, they've got their interest right there, and they never even had to say it was interest. And so that is why it's important to make sure you check all the terms and conditions of any kind of credit that you're applying for. If it's an auto loan, is the finance company, are you financing, let's say, your registration? Registration may only cost anywhere from $50 to $200 to register, depending on what state you're in. The goal of the dealer is to include as much as possible in your financing package, because that means you're going to be paying interest on those things. So are you paying attention to what's going into the debt or the credit that you're taking off? Same with your mortgage. Are there certain things that you should just pay up front versus having them rolled into your monthly mortgage? And again, if you're not paying attention, that is where the banks make the most money. Okay. And then in terms of managing credit, like I said, in terms of juggling, you want to use credit sparingly and pay it back responsibly. So you want to preferably pay your balances off in full every month, and you absolutely want to pay them on time. For this reason here, your payment history. Just because you pay it in the month doesn't mean it's on time. If they say it's due on the 17th, pay it on the 17th or by the 17th or before, preferably. Okay. And the amount you owe, you don't want to carry more than 30% of your available credit balances on your cards. Okay. Because the more credit you used up, it goes back to that reference. I gave this girl $1,000. She's using $999.99 every month, and she's paying her bare minimum. I don't really trust her to give more to her. And I'm also not sure if she's even going to pay this $999 off, because she's only paying the bare minimum every month. So this makeup of your score is really important. New credit, while it's only 10% of your score, every time you make an inquiry, it doesn't necessarily hit the score, but it does show up on your report. So if you get denied credit or something happens, they may say, oh, you've had X number of inquiries in the last 2 years. The industry is paying attention to how many times you're tapping that button to see if you can get a new card. The length of credit history is valuable. And so sometimes people don't have enough credit or don't have a long enough credit history. So if you just started using credit cards a year ago, it may be difficult for you to get a mortgage because you don't have history enough with the financial industry. And that's why the length of history is important. And lastly, your credit mix. And the credit mix is what kind of things do you have on your credit profile? You might have a credit card and a car note and a mortgage. Or does she have all store credit cards? A person with a credit profile that has all store credit cards shows me that they're an avid shopper. That is not necessarily an indication of overall financial well-being. Okay. So you want to have a credit mix that is reflective of a total life, for lack of a better word. So you have, you may have a few store cards, you may have a car note, even if it's not a car note you have now, because again, the goal is to pay it off, but she's had a car loan in the past, she had a mortgage, she rented an apartment. You want to have a profile that is well-rounded, but also well-managed. And that's where the juggling comes in. Paying off all your cards and then never using them again could hurt you, because then the credit card companies will close the cards. And now, again, you lose the credit history that went with that card. You no longer have the payment history there available. The amount you owe is not there, and it could almost wipe out your credit. And so your score could start going down if it's not active. So what I recommend for those people that are actively paying off their credit cards every month, you still want to use them. So maybe you charge your gym membership on one credit card every month. Maybe one card you use for gas and you pay it off every month. But you want to keep your cards active, but managing the balances that you owe and paying them off every month. So it shows that you are a positive participant in the financial industry. Okay. Tanya asked a great question. And then Regina, I saw your comment as well. Is it a good idea to pay ahead a month or so on your mortgage? If you have it, yes. It's also a good idea to pay ahead, or divide your payments in half and pay twice in a month on your car note, on your credit card, anything you pay that's charging you interest. If you cut the monthly payment in half and pay, let's say, once on the 15th and once on the 30th, or however, whenever your due date is, you want to pay twice by the time that due date happens, and only in the half amount. What that does is it accelerates the rate that you're paying it down faster than they're charging you interest. So they only charge you interest once a month. And the balance that they have when they charge you the interest is whatever's there on the account. So I did this with my car note. I actually do this with my car note. It takes a little while, or you at least have to be ahead in order to start doing this half approach. So I took 1 month and I just paid 2 car notes instead of paying the one. And from that point on, I started doing half my car note, with my first paycheck, the other half with my second. And it literally sped up the process eventually by almost 6 months, cutting off the time that I was paying, because I'm paying faster than they're charging me interest. And you can do that on your mortgage as well. And again, it didn't change how much I was paying every month. It just changed how frequent I was paying. And so that helps you to pay down debt faster. And it works that same way with your mortgage. Student loans. Does this apply to anyone? Does anyone recognize this elephant in the room? Either you're dealing with it for yourself or for your child or somebody in your family. Student loans are a part of your credit profile. And while federal loans may be paused for COVID, there may come back. I'm still praying that between Jesus and Joe Biden, they're going to disappear. But if they don't, you have to be in a good position to manage them. So there are 3 things that I like to say, and I'll give the points on this. First and foremost, borrow smart. Borrow only what you need, not what you need plus a refund check. Okay, this goes for your kids. Federal loans tend to be cheaper than private loans, meaning they charge a lower interest rate. So if you have to take out loans, you want to take out as many federal loans as possible. Caveat: avoid Parent Plus and all other parent loans at all costs. Your degree, your debt. I know people love their children. They want to be there to help provide them to go to college. If you didn't have a 529 and weren't able to save for them to go, do not take out parent loans. Why? Because it's almost like getting a credit card to pay for college. You are obligated to pay for that, whether they get a degree or not. Students tend to get the benefit of things like this COVID emergency response plan because they took on the debt. This is not to relieve parents. Parents' loans are still happening, even though most other federal loans are paused. Okay. And also, you don't want to be riddled with student loan debt when you're trying to retire. Okay. Parent Plus loans are never forgiven. There's no way to get out of them. It is debt that you have to pay. Okay. You also want to understand your student loan landscape. So maintaining a list of all your loans and the critical information. Most student loan packages are not just one loan. So you might see, okay, we're giving you $25,000 in federal loans. That $25,000 could be made up of 6 or 7 small federal loans that may all carry different interest rates, that may all have different terms, that will all have different payment amounts, and potentially different servicers. And if you don't know where all of your loans are, you could be messed up. Okay. So it is your responsibility to keep up with them. Pay them as you go if you're able. So if you are helping your student pay their loans off, or if you're in school now, try to pay some as you go so that you're paying less interest over time. But you want to review your list and update it regularly. The banks sell loans all the time. Even the federal government will sell loans, or at least change the servicer, even if it's still a federal loan. Like it might start with Sally Mae and end up with Navient and then end up over here. You got to keep track of who you're talking to. Okay. And that's important because, like I said, when it's time to pay up, you need to know your numbers, you need to explore your options, and make phone calls if needed. I have an MBA and a law degree, which means I have about as much student loan debt as my mortgage. I'm not proud of it, but it's what it took to get the degrees, okay? But what you have to do when it's time to pay them back is you need to be in position to say, what can I reasonably afford to pay every month on my student loan? Your budget will let you know that. If everything outside of your student loans and you only have about $500 left, then you know that you can probably only afford to pay between $300 and $400 a month on student loans. And that's fine. So what you want to do is, based on what you know your budget can withstand, then you want to explore your repayment options. Federal loans tend to have the most generous repayment options available. The income-based repayments, they have about 10 different income-based payment plans. Now, granted, over time, you may end up spending more on income-based repayment plans, but what that does is it allows you to take on a payment that your budget can withstand, meaning you can pay that amount consistently every month on time and not have any issues. Okay, it does not serve you, and this actually goes for any credit or debt account. It does not serve you to agree to a monthly payment that your budget can't withstand. And so this means even if your life circumstance changes, you might have been able to afford this payment when you first got the loan 2 years ago. But if your job changed, if you got downsized, if something happened, you need to call and ask to get your payments adjusted. It may not always work right away. You may have to speak to a couple different people. You may need to talk to the manager. But if you are clear on what your budget can withstand, you can make affirmative calls and ask for what you need from your lenders and from your creditors. I know I've lived through it. When I went to law school, I went from a corporate job at Johnson & Johnson to a nonprofit. I took a $50,000 pay cut at age 27 to go to a nonprofit because I wanted to do more work that was more meaningful to me. I did it. And then 8 months later, got invited to go to law school. And so I quit my full-time job and went to school full-time. But I still had a life. I had things I had to pay. I had car note, things I had to do. And so what I ended up doing was I had to call all of my creditors and say, listen, this is what's happening in my, with my life. I can only work X number of hours a month. I'm only bringing in this much. I used to bring in this much. This is what I can afford to pay you every month, at least for the 6 months that I'm in school during the semester. By summer, I can go back to my regular payments or do something different to catch up because I'll be working at a major law firm because I'm believing God that that's what's going to happen. That is exactly what happened. So what happened, all of my creditors, because I knew my budget and what I could withstand, my car note went from $250 a month to $22 a month while I was in law school during the semester, because I was able to clearly explain what I was going through, what my budget could withstand, and what I could do. And so for the time that I was in school during the semester, I was paying $22 a month. And then for my summers, when I was interning at a big law firm, I was able to come, pick back up on my payments during that time. And now that sounds crazy to a lot of people, but it saved me. And my credit score actually ended up going up while I was in school because I now had payments that I could afford. And I was paying them consistently and I was paying them on time. And lenders will do that with you. Like, you just can't avoid them. And the same thing applies with your student loans. If you go on income-based repayment, that helps you to stick to your agreements. And then there are special programs out there, public service loan forgiveness. If you work for the public sector or you work for a nonprofit, after making 120 on-time student loan payments, the balance of your loans tend to be forgiven. But if you have a loan payment that you can't afford to pay, you're not going to make that 120, which is why you have to use all of these things together. Okay. And like I said, if you can't pay, communicate. Refinance, defer, and forbear with caution. During COVID, a lot of private companies were going after people with federal student loans to encourage them to refinance their loans for lower interest rates. When you change a federal loan to a private loan, you lose all the benefits I just talked about. No more income-based repayment, no more potential for forgiveness. You're locked into a rate. You basically have a personal loan, and they want their money on time every month regardless. And so you don't want to refinance federal loans into private loans. Also, I just learned this last month when I was reassessing my loans when I thought they were going to start up again. The federal government does offer refinancing options into another federal loan. If you want to try to lower your interest rate, maybe your credit score is better than it was when you were in school. However, when you refinance federal loans, even into another federal loan, it restarts the clock for loan forgiveness. So I'm about 60% of the way through of my loan forgiveness possibility. Had I refinanced my federal loans, I would have lost all that history of payments and would be starting the clock at zero again. Talk about somebody that would have been upset. You have to read and explore the costs and implications of each option before you make a move. Okay. Let's see. Oh, this is good. With over 250K in student loans and a credit score of 796, with that impacting buying a home, should this person wait until? No, buy your house, sis. Buy your house with that kind of credit score. And so this is what I'll say this: as long as your student loans are in a positive in a positive circumstance, meaning they're not, you haven't missed a ton of payments. They're not, I can't even think of the word right now. You're not in the hole to the federal government. You've been paying them consistently on time, or if they're in the COVID scenario, what I would recommend is, at the very least, get your loans into a situation where you might have to like apply for income-based repayment so that the payment amount that they're going to charge you when they do restart will fit within whatever the bandwidth is for the mortgage that you're applying to. But go ahead and buy your house. I bought a house in the middle of COVID with student loans. Now, granted, my student loan payments, my payment history is positive. So it's not like I'm in the hole and have been avoiding my student loans. And my payment, again, because I'm on income-based repayment, is within what my budget can withstand. I was able to apply for a mortgage with no problem. Like, they didn't even ask about student loans when I did it. And with your credit score and what you're making, you should be able to get a home without it. But again, you have to be clear on being at a point of where your payments are within what your budget can sustain. Does that make sense? All right, so how do we get off the mountain of debt? We recommend 2 potential methods. The first of which is the snowball method, which focuses on paying down the smaller balances first and kind of making your way up to the higher balances of debts that you owe. So you list out all your debts from smallest balance to highest balance. Pay off the smallest thing first. Then use what would have been that monthly payment and add it to your next highest debt. And you do that until you're paid all your debts off. Okay. The flip side is if you do the avalanche method, which is focusing on the highest interest rate first, your debt with the highest interest rate, which means it's the most expensive debt you have. Now, the challenge with the avalanche method is that it tends to take longer, even though it's cheaper. Okay. Because you're trying to pay off based on interest rate. We recommend a combination of the two, where you would start off with the snowball method, where you're paying off the small balances and you're building up some, cash availability every month as you're paying off these small debts, and then switching to the avalanche method when you have, let's say, $200 extra available every month because you've paid off small bills. And then you move to the avalanche method, suddenly $200 is making a dent on that $5,000 credit card bill every month, that extra $200 payment. And so again, starting with the snowball and then moving to the avalanche gets you some early success and early access to some of that money that was before tied up in the debt section of your spending plan. And then moving to the avalanche method allows you to attack it and overall pay less money. Okay. I'm going to pause here because I want to get to this comment from Tanya Harris while you guys take a look at this. Is this helpful? Feel free to drop in the chat if there's anything else specific you want me to cover. I have a few more things. Something like that happened to me. I noticed. Yep. I was deployed, sent proof of deployment. Yep. Oh, no, wait, hold on. To this day, I still have to report. Yep, exactly. You want to make sure if you let people know what you're doing, the creditors can, I don't want to say they can advocate for you, but you are your biggest advocate with them. If you are clear and communicate what you need, those calls are documented, those calls are recorded. Even if nothing really, they will, hopefully, most lenders do have the ability to change your rates. And if you're willing to pay, but you just can't pay what they need you to pay, a lot of times they'll work with you because you're a better client than the person that puts their head in the sand and decides they're never going to pay ever. Okay. So use your communication to your advantage. Okay. All right. So I know I shared a lot quickly and I'll leave time for questions. But again, the goal here is to really find freedom in where you are right now. And by taking your budget, adjusting it to the spending plan, focusing on the debt area, you finally see an opportunity to potentially impact your financial well-being from where you are right now. And our goal is to help you improve your spiritual grounding, create a clear vision for how you're going to attack whatever the financial goal is, even if you're not in debt. It might be a forward-looking financial plan. You want to have a clear vision. You want to have a sound strategy and a workable plan, something that you can actively do to move yourself to a better financial situation. And with all of this happening, I don't know about you, but I hate to work all week and feel like all I'm doing is working to pay bills. Having a visual plan will give your work a little bit more purpose, because now you're working towards something as opposed to just paying bills every month. And ultimately you experience freedom and power. And so as I close, I just want to share this statement with you to think about for yourself. Freedom for me is, and so financial freedom and life freedom looks different for everyone. You want to think about what that is for you. And once you define that, think about what you have the power to do today to move you towards that goal. So I have the power to do something, but I must. Sometimes there's a sacrifice involved. We talked about Starbucks earlier. It might be the Starbucks, or it might be I need to take on another job. I must do something to help move myself forward. Like I have a pile of clothes over here in my corner that y'all can't see that I must sell. One, because I don't need them, but two, they will give me access to additional cash to do some things that I want to get done. And so that is the goal here. And not just financial freedom, but again, your money's doing what your life is doing. So if you are financially bound, 9 times out of 10, you just feel bound generally. You feel suffocated, you feel stressed, you have anxiety around managing your finances, and that's no way to live your life. And so our goal is to help you adjust your life, tweak your finances to get to a point where you can kind of live in freedom and power. So that is my presentation, your story, your strength, your strategy, financial freedom from the inside out. All of our website information is included here in addition to my email. Hopefully this was helpful, and I'll pause here for any live questions, or hopefully I'm good on time. I was not looking at the clock, but we'll see. So
you are excellent on time, Tamika. And I do have one more question from the private chat.
Okay.
It says, can you talk about people investing in their whole life insurance? I was told that the banks put money in whole life insurance because the interest rates from regular savings accounts is not good. And any insights that you could provide would be great.
Okay, so I'm not a financial advisor, so this is just based on life experience and based on what I've learned through dfree. Whole life policies tend to carry cash value in them, and so basically, if you have a whole life insurance policy, of course you get the death benefit of however much your policy is. But as you pay your premiums, your money is being invested, and it's growing a cash value. So in addition to, let's say you have a $500,000 life insurance policy, your kids will get the $500,000 when you die, but you will also in your lifetime have access to the cash value of your policy. So if you needed to, let's say you wanted to borrow money for the down payment on your house, and you have enough cash value in your life insurance policy, you could borrow the money from yourself. So remember I said earlier about people opting out of the financial services industry, you can almost create your own bank using whole life insurance. Now I will caveat it and say this. Some investment professionals or experts, there are products out there in the investment marketplace that are more lucrative than whole life insurance. However, they also require some level of effort. So there's more trading involved. You might have to have a certain advisor to, invest in these activities. For a lot of people, whole life insurance works because it's a steady payment every month. And you know that if you pay this money, it is going to grow in your whole life insurance policy. Whole life insurance is expensive, significantly more expensive than term life insurance for this very reason, because there is a cash value attached to it. Again, it's not for everybody. My recommendation is before you purchase anything, any financial instrument, besides opening a checking or a savings account, talk to a licensed financial advisor, whether it's a certified financial planner, a licensed insurance professional, any financial advisor that's worth their salt has passed a test that starts with a series something. You want a licensed professional to talk with you about your financial decision. A good financial advisor will meet with you initially for free so that they can kind of get a sense of what you're trying to do. Any financial advisor that wants you to cut a check before you sit down is not the person you want to work with, but you want a licensed professional to sit down and go through what your financial goals are, and that you can get independent. Not all financial advisors are fiduciaries. So that's the other thing. And so certain financial advisors are, paid directly by their companies to sell certain products. And while they do have a professional responsibility to you, a fiduciary is somebody that has to put your interests above and beyond their own. I prefer a fiduciary financial, advisor, but their rates may be higher on the back end. There are different things involved. But again, any certified financial professional should be able to give you independent advice from a more seasoned and expert place than just Joe Schmo on the street. A good place to start when looking for a financial advisor is your bank. Most banks have a team of financial advisors that they can provide to you. I also say treat selecting a financial advisor the way you treat finding a doctor. Personal recommendations help. Your friends that have financial advisors and they're good will love to share their financial advisor. So ask around. All right. Any other questions? I hope this was helpful. Y'all are quiet on a Saturday afternoon. I'm just going to assume y'all chilling out and sipping lemonade and getting some good information. All right. Well, if there are no more questions, I want to thank you for the opportunity to share with you this afternoon. I love doing these kind of things. And like I said, I've been with dfree for 8 years, and God has used my financial mishaps to be a blessing to others. And so I don't mind sharing my personal testimony, in addition to, whatever information I've learned. What I know, you know. And so thank you all so much for your time. And I'll turn it back over to Christina.
All right. Well, first and foremost, thank you. This is probably one of the best presentations I have heard. I guess because it was real, it was relatable. And I think it's just because you bring that energy and that realness to your presentation. And I even told Tamika when she came on, I was like, oh, I love that background, all that black girl magic in the back. So we just want to say thank you so much for you taking time, even on your Saturday afternoon, to be here with us today, to make us smarter about financial freedom. Any little tidbits that we can take away, not just for ourselves, but to also carry to other people. Because I also think it's important to be a resource for others.
Yeah.
And what I'm going to do is I'm going to give the floor to our chapter president, Tanya Young, who will close us out. So again, I just want to again say thank you. And if Tanya, you want to come on and close us out before everybody shuts down this afternoon and enjoys the rest of their weekend.
Well, good afternoon, everyone. Ms. Stembridge, thank you so much on behalf of the ladies of the Leavenworth Alumni Chapter, as well as those who in the Leavenworth community did not consider it robbery to tune in with us this afternoon. Thank you so much for sharing some very, very good strategies, tips, and pointers with us. I definitely took note of them. And thank you especially for normalizing that it is not a shameful thing to be where you are and to work incrementally from wherever you are, and that you don't have to feel less than because maybe you have more debt than someone else, or maybe you're at a lower quote unquote starting place than someone else. So thank you so much for sharing your wisdom with us, and we look forward to making progress on our own individual financial paths because of what you shared today.
Excellent. Thank you. That is always my goal, because finance is so hard to talk about. It's so hard to face. And a lot of us are individually suffering, for a lack of knowledge or whatever it is. And so I thank you. I always thank Delta for bringing this conversation forward. Like I said, you are the first sorority to have taken dfree under your wing. And so whatever we can do to help empower you all to go out into the community and serve the way you do, we're here to do it.
Thank you so much. We enjoy this partnership, and we look forward to many more years of partnering together on this financial journey.
Excellent.
Yep. All right. Thank you. And again, thank you to everyone for being here, family, friends, and SARS who are here far and wide. So thank you all. We love you, and have a fantastic weekend.
Excellent. Thank you, ladies. Bye-bye.
Have a great afternoon, everyone.